Sir, please start.
Okay. So good morning to all of you and welcome back. So for this session, strategic financial management is concerned. Now we have already discussed about the basics. So for the capital budgeting is concerned, and we have discussed up to average rate of return. Now we are going to consider discounted cash flow technique, and for our recapitalization we are going to first discuss few theoretical concepts, then we will go to solve the problems. Now we are having the net present value method. The NPV method of investment appraisal is to accept projects with a positive NPV. So if any project having positive NPV, that is net present value, so we are going to accept that. Now timing of cash flows, that is cash inflows, is very important in the context of net present value method. That is profit after tax, add back, depreciation. And we have to ensure that we are aware of the three conventions concerning the time of cash flows. Now, annuity is a constant cash flow for a number of years. A perpetuity is a constant cash flow forever. So net present value or NPV is the value obtained by discounting all cash outflows and inflows of a capital investment project by a chosen target rate of return or cost of capital. Now here, target rate of return is your cost of capital. It may be weighted average cost of capital or the desired rate of return. This is also called cut-off rate, cut-out rate, or financial break-even point. The NPV method compares the present value of all the cash inflows from an investment with the present value of all the cash outflows from an investment. The NPV is thus calculated as the present value of cash inflows minus the present value of cash outflows. Now, with NPV, we are going to make the decision. If NPV is positive, return from investment cash inflows is in excess of cost of capital, then we are required to undertake the project. If NPV is negative, that is return from investments cash inflows below cost of capital, then don't undertake the project. Now, NPV, if it is zero, return from investments cash inflows same as cost of capital. Now, we may undertake or may not undertake the project, but if NPV is zero, then if we are in a position to manage the cash inflows accordingly, then we may undertake the project. Otherwise, we are going to reject it. Now we assume that the cost of capital is the organization's target rate of return. Now we are coming to internal rate of return method. Now, as the name suggests, internal rate of return. So there is a trial and error procedure. The IRR method of investment appraisal is to accept projects whose IRR, the rate at which the NPV is zero, because internal rate of return lies between one positive and another one negative NPV. That is, where NPV is zero, the IRR method of investment appraisal is to accept projects whose IRR, the rate at which the NPV is zero, exceeds a target rate of return. and we are going to use the interpolation formula for the calculation of internal rate of return. Now, using the NPV method of discounted cash flow, present values are calculated by discounting at a target rate of return or cost of capital, and the difference between the PV of costs and the PV of benefits is the NPV. Okay, so you remember, using the NPV method of discounted cash flow, present values are calculated by discounting at a target rate of return or cost of capital, or desired rate of return, or cutout rate or cutoff rate. And the difference between the present value of costs and the present value of benefits is the NPV. But if we are going to compare internal rate of return, that is in contrast, internal rate of return method is to calculate the exact discounted cash flow rate of return which the project is expected to achieve. In other words, the rate at which the NPV is zero. If the expected rate of return, that is the IRR or DCF yield, exceeds a target rate of return, the project would be worth undertaking. Now here we are ignoring risk and uncertainty factors. So without a computer or calculator program, the calculation of the internal rate of return is made using a hit and miss technique known as the interpolation method. So we are having step 1, calculate the net present value using the company's cost of capital. Step 2, having calculated the NPV using the company's cost of capital, calculate the NPV using a second discount rate. Now, if we are going to calculate with a discount rate where you see the NPV is positive, then we are going to apply a higher rate where NPV will be negative. So that's why I have said calculate the net present value using the company's cost of capital. And step 2, having calculated the NPV using the company's cost of capital, we are required to calculate the NPV using a second discount rate. Remember, in the examination hall, time management is important. Hence, if we are going to start with a particular rate and where we find NPV is positive, then we should proceed to take another higher rate of discounting rate so that NPV is negative. So you have to restrict into two discounting factors. Otherwise, there will be problem in time management in the examination hall. So if the NPV is positive, use a second rate that is greater than the first rate. If the NPV is negative, use a second rate that is less than the first rate. Step 3, use the two NPV values to estimate the IRR. The formula will be IRR is equal to A plus NPV of A divided by NPV of A minus NPV of B multiplied by B minus A, that is in percentage, where A is the lower of the two rates of return used, B is equal to the higher of the two rates of return used. NPV suffix A, the NPV obtained using rate A, and NPV suffix B, the NPV obtained using rate B. Ideally, NPV A will be positive value and NPV B will be negative. If NPV B is negative, then in the equation above, you will be subtracting a negative, that is treating it as an added positive, because you see B minus A that is NPV of A divided by NPV of A minus NPV of B, that is multiplied by B minus A. That is the thing I have said. That is ideally NPV suffix A will be a positive value and NPV suffix B will be negative. If NPV is negative, then in the equation that I have said, the formula, you will be subtracting a negative, then minus minus, it will be a positive one. Now we are going to make a comparison between NPV and IRR, because many times the questions are coming on this issue. That is how we are going to make a comparison between NPV and IRR. Now, here the first point is, when cash flow patterns are conventional, both methods give the same accept or reject decision. So I'll be telling you, conventional, that is, say every year there is an increase in the cash inflows, and non-conventional means, you see in the 0th year there will be a cash outflow, then in the first year there is a positive cash inflows, and in the second year there is a negative cash inflow. That is called non-conventional. Conventional cash flows means an initial cash outflow followed by a series of inflows. So what I have said, in the context of NPV and IRR comparison, when cash flow patterns are conventional, both methods give the same accept or reject decision. The IRR method is more easily understood. NPV is technically superior to IRR and simpler to calculate. IRR, or accounting rate of return or return on capital employed, can be confused. IRR ignores the relative sizes of investments. Where cash flow patterns are non-conventional, there may be several IRRs which decision makers must be aware of to avoid making wrong decisions. Now, in case of mutually exclusive projects, that is, mutually exclusive project means when there are two projects in the pipeline, you are going to select one project and you are going to reject outrightly the next project, the other project. So mutually exclusive projects are two or more projects from which only one can be chosen. Examples include the choice of a factory location or the choice of just one of a number of machines. The IRR and NPV methods can, however, given conflicting rankings as to which project should be given priority. Let us suppose that a company is considering two mutually exclusive options, option A and option B. The cash flows for each would be as follows. Cash outlay, net cash inflows given, so far year 1, 2, 3 is concerned. Company's cost of capital is 16%. Then the NPV of project is calculated under option A and option B, and we are having NPV that is positive 610 and NPV that is also positive in case of option B. Now, the reinvestment assumption underlying the IRR method cannot be substantiated. Now, what is the meaning of reinvestment assumptions? That I am going to say, an assumption underlying the NPV method is that any net cash inflows generated during the life of the project will be reinvested at the cost of capital, that is the discounting rate. The IRR method, on the other hand, will be reinvested at the cost of capital, that is the discount rate. The IRR method, on the other hand, assumes these cash flows can be reinvested to earn a return equal to the IRR of the original project. Now, in the example that I have already given over here, that NPV method assumes that the cash inflows of rupees 6,000, 5,000 and 3,000, 6,000, 5,000 and 3,000 for option A will be reinvested at the cost of capital of 16%, whereas the IRR method assumes that they will be reinvested at 20%. Okay, so the idea is, in the theory, a firm will have accepted all projects which provide a return in excess of the cost of capital. Any other funds which becomes available can only be reinvested at the cost of capital. This is the assumption implied in the NPV rule. Now, when discount rates are expected to differ over the life of the project, such variations can be incorporated easily into NPV calculations, but not into IRR calculations. Despite the advantages of the NPV method over the IRR method, the IRR method is widely used in practice. Now, assessment of DCF methods of project appraisal. DCF methods of appraisal have a number of advantages over other appraisal methods. The time value of money is taken into account. The method takes account of all of project's cash flows. It allows for the timing of cash flows. There are universally accepted methods of calculating the NPV and IRR. Now, DCF is a capital appraisal technique that is based on a concept known as the time value of money. The concept that rupee 1 received today is not equal to rupee 1 received in the future. Given the choice between receiving rupees 100 today and rupees 100 in 1 year's time, most people would opt to receive rupees 100 today because they could spend it or invest it to earn interest. If the interest rate was 10%, you could invest rupees 100 today and it would be worth 100 into 1.1, that is rupees 110 in 1 year's time. There are, however, other reasons why a present rupee 1 is more than a future rupee 1. Now we are coming to the concept of uncertainty. Although there might be a promise of money to come in the future, it can never be certain that the money will be received until it has actually been paid. Now, inflation also means rupee 1 now is worth more than rupee 1 in the future because of inflation. The time value of money concept applies even if there is zero inflation, but inflation obviously increases the discrepancy in value between monies received at different time periods. Taking into account of the time value of money by discounting is one of the principal advantages of the DCF appraisal method. Other advantages are the method uses all relevant cash flows relating to the project. It allows for the timing of the cash flows. There are universally accepted methods of calculating NPV and the IRR. Now, there are certain problems which are actually being involved with DCF method. Although DCF methods are theoretically the best methods of investment appraisal, you must be aware of their limitations. DCF methods use future cash flows that might be difficult to forecast. Although other methods use these as well, arguably the problem is greater with DCF methods that take cash flows into the longer term. The basic decision rule accept all projects with a positive NPV will not apply when the capital available for investment is rationed. So in a capital rationing concept, we are not going to accept the projects all are having a positive NPV. The cost of capital used in DCF calculations may be difficult to estimate. The cost of capital may change over the life of the investment. So these are all about your discounted cash flows method. Now, when I am going to talk about the inflation and taxation, that is allowing for inflation and taxation. Inflation is a feature of all economies, as you know, and it must be accommodated in financial planning. Real cash flows that is adjusted for inflation should be discounted at a real discount rate. Nominal cash flows should be discounted at a nominal discount rate. So mind this, real cash flows that is adjusted for inflation should be discounted at a real discount rate, and nominal cash flows should be discounted at a nominal discount rate. So far, we have not considered the effect of inflation on the appraisal of capital investment proposals. Now, as the inflation rate increases, so will the minimum return required by an investor? For example, you might be happy with a return of 5% in an inflation-free world. But if inflation were running at 15%, you would expect a considerably greater yield. The nominal interest rate incorporates inflation. When the nominal rate of interest is higher than the rate of inflation, there is a positive real rate. When the rate of inflation is higher than the nominal rate of interest, the real rate of interest will be negative. So you have to remember this. Now, the relationship between real and nominal rates of interest is given by the Fisher formula. The formula is 1 plus I is equal to 1 plus R multiplied by 1 plus H, where H is equal to rate of inflation, R is equal to real rate of interest, and I is equal to nominal, that is money rate of interest. Now let us look. A company is considering investing in a project with following cash flows. Time 0, 1, 2, 3, cash outflow 15,000, and over the years there are cash inflows, that is 9,000, 8,000 and 7,000. The company requires a minimum return of 20% under the present and anticipated conditions. Inflation is currently running at 10% a year, and this rate of inflation is expected to continue indefinitely. Should the company go ahead with the project? So the concept is minimum desired rate of return is 20%. So for the present and anticipated conditions are concerned, inflation is currently running at 10% a year, and this rate of inflation is expected to continue indefinitely. Should the company go ahead with the project? So that is a relevant question. Now, let us first look at the company's required rate of return. Suppose that it invested rupees 1,000 for 1 year on 1st January. Then on 31st December, it would require a minimum return of rupees 200, 20% rate. With the initial investment of rupees 1,000, the total value of the investment by 31st December must therefore increase to rupees 1,200. During the course of the year, the purchasing value of the rupee would fall due to inflation. We can restate the amount received on 31st December in terms of the purchasing power of the rupee on 1st January as follows. In terms of the value of the rupee 1 on January, 1st January, the company would make a profit of rupees 91, which represents a rate of return of 9% in today's money terms. This is the real rate of return. The required rate of 20% is a nominal rate of return, sometimes called a money rate of return. The nominal value measures the return in terms of rupee, which is of course falling in value. The real rate measures the return in constant price level terms. The two rates of return and the inflation rate are linked by the equation 1 plus I is equal to 1 plus R multiplied by 1 plus H, where all rates are expressed as proportions. So in your example, we have 1 plus 20%, that is 0.2 into 1 plus R multiplied by 1 plus 10%, that is 0.1, so that R is equal to 9.1%, where H is rate of inflation, R is real rate of interest, and I is equal to nominal money rate of interest. Now, in inflation situations, we are going to take the formula that is 1 plus I is equal to 1 plus R into 1 plus H. Now, do we use the real rate or the nominal rate? The rule is as follows. If the cash flows are expressed in terms of the actual number of rupees that will be received or paid on the various future dates, we use the nominal rate for discounting. So remember, if the cash flows are expressed in terms of the actual number of rupees that will be received or paid on the various future dates, we use the nominal rate for discounting. If the cash flows are expressed in terms of the value of rupee at time zero, that is in constant price level terms, we use the real rate. So mind this, when you are going to use the nominal rate for discounting and when you are going to use the real rate. The cash flows given above are expressed in terms of actual number of rupees or dollars that will be received or paid at the relevant dates, that is nominal cash flows. We should therefore discount them using the nominal rate of return. The cash flows given above are expressed in terms of the actual number of rupees or dollars, as you please, that will be received or paid at the relevant dates, nominal cash flows. We should therefore discount them using the nominal rate of return. That is discounting factor 20%, and we get the cash flows discounting factor 20% and the present value. So cash flows, that is cash outflow 15,000, discounting factor at the rate 20% at T0 time period is 1. So we are having 15,000, that is an outflow. Then 9,000 at the end of year 1, the discounting factor at the rate 20% is 0.833. It comes to 7497. Then 8,000 discounting factor is 0.694. It comes to 5552. And 7,000 is the cash flow, discounting factor 0.579. It comes to 4053. The project has a positive net present value of 2102. The future cash flows can be re-expressed in terms of the value of the rupee at time zero as follows, given inflation rate at 10% a year. So time, we are going to consider actual cash flows, and that is outflows and inflows. We are going to consider, that is 10% the inflation, that is 9,000 into 1 by 1.10, it comes to 8182. Number 2, 8,000 into 1 by 1.10 square, it comes to 6612. And cash inflow 7,000, that is 7,000 into 1 divided by 1.10 to the power cube, it comes to 5259. The cash flows expressed in terms of the value of the rupees at time zero, real cash flows can now be discounted using the real rate of 9.1% that we have got. So after considering the cash flows expressed in terms of the value of the rupees at time zero, that is real cash flows, can now be discounted using the real rate of 9.1% that we have already got. So it comes to, that is at 0 at time, cash flow is 15,000, cash outflow, discounting factor is 1. So there is no question of any inflationary effect. So what the T0 time period is concerned. Then 8182, what we have got, that is 8182, that is to be multiplied by 1 divided by 1.091. So it comes to 7,500. Second year 6612 multiplied by 1 divided by 1.091 square, it comes to 5,555. Third year 5259, that is 1 divided by 1 plus 091 to the power cube, it comes to 4050. So NPV is 2105. Now you see this NPV that we have got, okay, that is 2102. This is calculation rounding off. NPV is 2105. The NPV is the same as before, and the present value of the cash inflow in each year is the same as before, apart from rounding errors. Now, although generally companies should discount money values at the nominal cost of capital, there are some advantages of using real values discounted at a real cost of capital. When all cost and benefit rise at the same rate of price inflation, real values are the same as current day values, so that no further adjustments needed or need to be made to cash flows before discounting. In contrast, when nominal values are discounted at the nominal cost of capital, the prices in the future years must be calculated before discounting can begin. The government might prefer to set a real return as a target for investments as being more suitable than a commercial money rate of return. Now we are coming to a problem. Please try to understand the problem. Project New Vision is a strategically important project which the board of XYZ company has decided must be undertaken in order for the company to remain competitive regardless of its financial acceptability. The project has a life of 4 years. You are the project consultant of the company and you have generated the following information from the annual reports of the company. Year 1, 2, 3, 4, sales follow units 12,000, 13,000, 10,000 and 10,000. Selling price rupees per unit 450, 475, 500 and 570. Variable cost per unit 260, 280, 295 and 320. Fixed cost in 1,000, 750 for all the years. Now, these forecasts are before taking into account of selling price inflation of 5% per year, variable cost inflation of 6% per year, and fixed cost inflation of 3.5% per year. The fixed cost are incremental fixed cost, which are associated with Project New Vision. Remember, fixed costs are incremental fixed cost, that is additional fixed cost. At the end of 4 years, machinery from the project will be sold for scrap with a value of rupees 4 lakhs. Tax allowable depreciation on the initial investment cost of project New Vision is available on a 25% reducing balance basis, and XYZ company pays corporation tax of 28% per year, 1 year in arrears. Mind this, Again, I repeat, tax allowable depreciation on the initial investment cost of project, new vision is available on a 25% reducing balance basis, and XYZ company pays corporation tax of 28% per year, 1 year in arrear. A balancing charge or allowance is available at the end of the 4th year of operation. Now, XYZ company has a nominal after-tax cost of capital of 13% per year. The initial investment of project new vision is given. As a project consultant, you are required to calculate the nominal after-tax net present value of project new vision and comment on the financial acceptability of this project. So this type of problem is very, very important for the examination point of view, where we are required to consider so many factors, and that we are going to consider. Now, your answer should be, I'm just doing it in rupees 1000. So we are having, you see, year given 1, 2, 3, 4, but we are considering because there is a tax which is to be paid. Just look into the question once more. Tax allowable depreciation on the initial investment cost of project. New vision is available on a 25% reducing balance basis, and XYZ company pays corporation tax of 28% per annum or per year, 1 year in arrears. So that's why you are going to make the computation up to the 5th year. So we are going to take, first I am just going through this, then we will be coming to the working notes, because once you do the working notes, then you are in a position to construct this. Now we are going to consider sales, that is as per working note 1. Sales, year 1, 2, 3, 4, we have taken volume, that is 12,000, 13,000, 10,000 and 10,000. Selling price 450, 475, 500 and 572. Inflation, year 1, 1.05 to the power 1. Then we get the revenue. Then second year 13,000, price is 475. Inflation rate will be 1.05 to the whole square, and if revenue comes to 6807938. In the third year, we are having 1.05 whole to the power cube, that is 5788125. And year 4, we are having 10,000, price is 570. Inflation is 1.05 to the power 4. It comes to 6,92,8386. So once we get it, we are going to put it into the sales as per working note 1, that is 5670, 6808, 5788 and 6928 in 1000. Then we are going to calculate the variable cost as per note 2. Variable cost will be, that is 6% inflation at a volume of 12,000, per unit is 260. Inflation being 6%, it comes to 1.06, and cost we get 3307,200. In the second year, volume is 13,000, per unit is 280. So inflation will be 1.06 whole square. It comes to 4089904. In third year, 10,000, per unit is 295. So 1.06 to the power cube, it comes to 3513497. In the fourth year, we are having a volume of 10,000, that is 320. inflation 1.06 whole to the power 4, it comes to 4039926. So once we get the variable cost, we are going to project here, that is cost. That's why we have taken in the bracket 3307, 4090, 3514 and 4040. Now we are going to have fixed cost. Also there will be an inflation as per note 3. So we are going to have, you just have a look in the problem, just have a look. It is given fixed cost inflation of 3.5% per year. So we are going to calculate the inflation adjusted fixed cost, that is amount is same since it is fixed cost, and fixed cost is fixed up to 100% activity level. And remember, there is no fixed cost in the long run. All costs tend to vary in the long run. Now, amount we are having 750, inflation rate is 1.035. So cost we get 776050. Year 2 amount is 750. Inflation, that is 1.035 to the power whole to the power square, that is 105 whole to the power 2, that is 803419. In the third year, 750, then 1.035 whole to the power 3, it comes to 831538. And fourth year, 750, that is rupees in thousand, then 1.035 to the power 4, it comes to 860642. So we are going to put it in the calculation fixed cost. So once we are having sales, then we are deducting variable cost, then we are having fixed cost that we are also deducting. So we will be having taxable cash flow at the end of year 1, 1587, at the end of year 2, 1915, at the end of year 3, 1442, at the end of year 4, it is 2027. Now we are going to have tax. The tax is given, you see, 28% per year. So we are going to deduct the tax amount. Okay. So it will be deferred by 1 year. So first year, that will come in second year, that is 444, then 536, then 404, then 568. Capital cost is 5 lakhs, 5,000, and there will be a scrap value. You see, scrap value of 4 lakhs that we are going to have at the end of the fourth year. Then tax shield on depreciation. Here tax shield means tax savings on depreciation, that we have calculated under note 4. So in the note 4 we are going to have tax allowable depreciation, tax benefits. Here adjustment is 25%, taxable, tax allowable depreciation, then tax benefit. So we have got 1, 2, 3, 4, and there will be a balancing charge because scrap value is 4 lakhs and tax benefit we have calculated, and tax benefits and tax charges affect the following period since tax is paid in arrears. So we have already calculated tax allowable depreciation tax benefits, that is year 1, 2, 3, 4, and again we are having a scrap value at the end of the fourth year, and we are going to have the balancing charge of 1,709,375. So we have calculated this and we are going to put into the main calculations, that is 350, 263, 197 and 479. So we are having 5,000, 1,000, that is rupees in 1,000, 5,000, then 1587, then 1821, 1169, 2220, and last one is 89 negative. So we are going to have net present value, that is outflow at T0 time period 5,000. Then we are going to multiply 1587 with the discounting factor at the end of year 1 so that we can get 1405. Next, multiplying it, that is 1821, multiplying it the discounting factor, we get 1426, multiplying 1169 with the discounting factor, we get 810. Then 2220 multiplied by the discounting factor, we get 1361, and 89 with the discounting factor, we get 48 negative. So net present value is 46,000. Now the net present value is negative and the investment is not financially worthwhile. However, the board have decided that it is strategically important to undertake this project. So what we have learned, let us make the summary. If you are given certain project, and here you see project New Vision is a strategically important project. So it is not based on the mutually exclusive concept. It is strategically important, and company has decided must be undertaken in order for the company to remain competitive, regardless of its financial acceptability. So when we are actually provided with this information, that is sales volume units, selling price, variable cost, fixed cost, and when there is an inflationary effect, so for the sales volume and sales price, variable cost and fixed cost are concerned. So selling price inflation 5% per year, variable cost inflation 6% per year, and fixed cost inflation 3.5% per year. Then we are required to accommodate this inflation factor, and we are going to calculate the revised sales, then revised variable cost, fixed cost, and then we are going to calculate the taxable cash flow. Then we are going to have tax shield, and income tax is actually to be 1 year arrear. So that's why we have made 5th year also, and we have jotted down the tax that is from year 2nd, 3rd, 4th and 5th. Then we are having scrap value and tax shield on depreciation that we have calculated. Once we calculate, then we are going to discount it with the discounting factor as it is given in the question. You see, it is given 13% per year. So in calculator, you can easily calculate 1 divided by 1.13. In that manner, you can go ahead and calculate the discounting factor, and we calculate the net present value, that is 46,000, that is negative. But we are not in a position to reject this particular project because on the ground that it is not financially worthwhile, because it is strategically important to undertake this project, we have to undertake the same. Hope you have understood what I have said. Now we are coming to taxation, that is allowing for taxation. Taxation is a major practical consideration for businesses. It is vital to take it into account in making decisions. In investment appraisal, tax is often assumed to be payable 1 year in arrears. Tax allowable depreciation detail should be checked in any question you attempt. So far, in looking at project appraisal, we have ignored taxation. However, payments of tax or reduction of tax payments are cash flows and ought to be considered in discounted cash flow analysis. Assumptions which may be stated in questions are as follows. Tax is payable in the following the one in which the taxable profits are made. Thus, if a project increases taxable profits by 10,000 in year 2, there will be a tax payment assuming tax at 30% of rupees 3,000 in year 2. Then net cash flows from a project should be considered as the taxable profits, not just the taxable revenues arising from the project, unless an indication is given to the contrary. Then tax allowable depreciation, that is capital allowance is used to reduce taxable profits and the consequent reduction in a tax payment should be treated as cash savings arising from the acceptance of a project. For example, suppose tax allowable depreciation is allowed on the cost of plant and machinery at the rate of 25% on a reducing balance basis. Thus, if a company purchases a plant costing rupees 80,000, the subsequent writing down allowances would be as follows. That is, year 1, 2, 3, 4, tax allowable depreciation, 25% of cost. Okay, reducing balance is 60,000, then 25% of reduced value, or reducing value 15,000, reducing balance is 45,000. Then third year 25% of reduced value or reducing value 11,250, reducing balance is 33,750, and 25% of reducing value, that is 8,438, it comes to 25,312, the reducing value. When the plant is eventually sold, the difference between the sale price and the reducing balance amount at the time of sale will be treated as number A taxable profit if the sale price exceeds the reducing balance, and as a tax allowable loss if the reducing balance exceeds the sale price. So that is all about your taxation. Now we are coming to the concept of working capital, because at the time of the beginning of the project, you will be investing in working capital, and definitely the working capital will be recovered at the end of the life of thousand working capital requirement at the end of year 1, rising to rupees 30,000 at the end of year 2. The DCF calculation will show rupees 20,000 as year 1 cash outflow and rupees 10,000, that is 30,000 minus 20,000, as year 2 cash outflow. Working capital is assumed to be recovered at the end of the project, and the example that I have given here, this will be shown by a rupees 3,000 cash inflow in year 5, assuming the project having a life of 5 years. So working capital consideration is a very important phenomena in the context of capital budgeting decision, and we are required to consider the cash outflows accordingly, and ultimately At the end of the life of the project, whatever working capital that is actually being needed will be recovered, and that will be shown as cash inflows, of course, at discounted value. Now we are coming to risk and uncertainty in the context of investment decision and project appraisal. Now, risks can be applied to a situation where there are several possible outcomes, and on the basis of past relevant experience, probabilities can be assigned to the various outcomes that could prevail. Uncertainty can be applied to a situation where there are several possible outcomes, but there is little past relevant experience to enable the probability of the possible outcome to be predicted. So there are a wide range of techniques for incorporating risks into project appraisal. So risks and uncertainty factors are also required to be considered in capital budgeting decision. Now, let us make a distinction between risk and uncertainty in the context of project appraisal or investment decision. Now, truly speaking, risk means several possible outcomes on the basis of past relevant experience, assign probabilities to outcomes. Third, increases as the variability of return increases. So risk is nothing but several possible outcomes on basis of past relevant experience. We are required to assign probabilities to outcomes, and increases as the variability of return increases. Uncertainty, several possible outcomes, little past experience, thus difficult to assign probabilities to outcomes, and it also increases as project life increases. So risk and uncertainty, although there are elements which are common, but it is not same. Now, a risky situation is one where we can say that there is a 70% probability that returns from a project will be in excess of rupees 1 lakh, but a 30% probability that returns will be less than rupees 1 lakh. If, however, no information can be provided on the returns from the project, we are faced with an uncertain situation. So please try to understand what is called risky situation and what is called uncertainty. In general, risky projects are those whose future cash flows and hence the project returns are likely to be variable. Of course, so the greater the variability is, the greater the risk. The problem of risk is more acute with capital investment decisions than other decisions for the specific reasons. Estimates of capital expenditure might be for several years ahead, such as for major construction projects. Actual cost may escalate, that is increase, well above budget as the work progresses. Secondly, estimates of benefits will be for several years ahead, sometimes 10, 15 or 20 years ahead, or even longer, and such long-term estimates can at best be approximations. So these are the problems of risk and in the context of capital budgeting decision. Now, just we are going to consider a problem, just have a good look. Just a minute. ABC Limited is considering two mutually exclusive projects, A and B. Project A cost rupees 36,000 and project B rupees 30,000. You have been given below the net present value probability distribution for each project. As a finance manager of the company, you are required to ascertain the following. The expected net present values of projects A and B, the risk attached to each project, there is standard deviation of each probability distribution, the profitability index of each product. Which products do you recommend? State with your reasons. So we are having project A, NPV estimate and probability. Similarly, project B, NPV estimate and probability. Now, this is an usual problem we should go for calculating NPV and standard deviation for project A and project B respectively. So we are calculating expected value. Expected value is considered to be the mean value. So in project A, we are having NPV estimates, we are having probability. NPV estimates multiplied by probability, we get expected value. We have calculated the expected value of project A, taking into consideration the NPV estimates, probability, and if probability is multiplied by NPV estimates, we get expected value. Similarly, for project B, that is NPV estimate, probability, and expected value. And if you look, expected value for project A and project B are same. Hence, if this is a mutually exclusive project, we are going to select either of the project, but if there is risk and uncertainty, then the expected value decision, we are not in a position to take into account to justify which project is actually to be selected. Hence, we should go for calculating the standard deviation. And another concept is there, that is coefficient of variation. Okay, that is standard deviation by mean into 100. So standard deviation is the standard deviation is one which is going to show us the project standard deviation, going to show us the risk attitude or aptitude so far the projects are concerned. So we are having probability, then we are having NPV estimates, then we are taking deviations, that is x minus expected values, then x minus expected value whole square multiplied by probability, and if you add the last column, we get the variance. Variance is the variance we get, and if we are going to calculate standard deviation, then we are going to take the square root of variance, that is standard deviation of project, we get 4450. Similarly, we are going to calculate the variance so far project B is concerned, jotting down the probability, then NPV estimates, then x minus expected value, then x minus expected value whole square multiplied by probability. Here probability is given so far project B is concerned, then we are going to calculate the standard deviation of project B. It comes to 3795. So standard deviation of project A is 4450 and standard deviation of project B is 3795. Now, computation of profitability of each product, that is cost benefit, that is profitability index, that is discounted cash flow divided by initial outlay. So in case of project A, we get profitability index is 1.25, and in case of project B, we get profitability index, that is 1.30. Now, measurement of risk is made by the possible variation of outcomes around the expected value, and the decision will be taken in view of the variation in the expected value, where two projects have the same expected value, the decision will be the project which has smaller variation in expected value. Standard deviation is the nothing but is the root mean square deviation from mean. Hence, we are going to have the concept that is measurement of risk is made by the possible variation of outcomes around the expected value, and the decision will be taken in view of the variation in the expected value where two projects have the same expected value. Then the decision will be the project which has smaller variation in expected value, that is smaller standard deviation. In the selection of one of the two projects, A and B, project B is preferable because the possible profit which may occur is subject to less variation or dispersion. Much higher risk is lying with project A because we have already calculated standard deviation of project A is 4450 and standard deviation of project B is 3795. Hence, obviously project B will be selected. And in case of profitability index, a project having higher profitability index is selected, that is B project where it is 1.30. So it is the gross profitability index, and if we deduct 1.25 minus 1, it is 0.25, and 1.3 minus 1, that is 0.30, that is the net profitability index, is also higher in case of project B, and that we are going to select. Now we are coming to a next problem. High-tech company is considering investing rupees 50,000 in a new machine with an expected life of 5 years. The machine will have no scrap value at the end of 5 years. It is expected that 20,000 units will be sold each year at a selling price of rupees 3 per unit. Variable production cost are expected to be rupees 1.65 per unit, while incremental fixed cost, mainly the wages of a maintenance engineer, are required to be rupees 10,000 per year. High-tech company uses a discount rate of 12% for investment appraisal purposes and expects investment projects to recover their initial investment within 2 years. Mr. X is the financial controller of high-tech company, and the finance director of the company wants to know about the following. The necessity of the risk and uncertainty that should be considered in the investment appraisal process to calculate and comment on the payback period of the project. Okay. Now, so what is our intention here? High-tech company uses a discount rate of 12% for investment appraisal purposes and expect investment projects to recover their initial investment within 2 years. Mr. X is the financial controller of high-tech company, and the finance director of the company wants to know about the following. The necessity of the risks and uncertainty that should be considered in the investment appraisal process to calculate and comment on the payback period of the project. So it is a case study type question. Okay, so just go through this and allow me 2 minutes time, and I am going to discuss all these things, that if a question like this comes, how to answer this type of question, okay, in the examination hall, that we are going to discuss. Just have a look. Now, how your answer should be in the examination hall, that I am going to discuss. The probability of winning or losing something worthy is known as risk. Uncertainty implies a situation where the future events are not known. Decision making is about selecting the best alternative from among an array of alternatives. The best alternative refers to that particular alternative which helps a firm to maximize its profit or minimize its cost. In decision theory, the alternatives are preferred as acts and the possible events are referred as state of nature, outcomes of a random process. So, mind this, in decision theory, the alternatives are referred as acts and the possible events are referred as states of nature, that is outcomes of a random process. Now, capital budgeting is a process of identifying, analyzing and selecting investment to determine a firm's expenditure on assets whose cash flows are expected to extend beyond 1 year. It is an important process because capital expenditures require large investment but limited by the availability of funds, that is capital rationing. Greatly influences a firm's ability to achieve its financial objectives and can become as a tool of control. Uncertainties can exist when the outcome of an event is not known for certain and when dealing with assets whose cash flows are expected to extend beyond 1 year. Suddenly, there is element of risk in that situation. The evaluation of risk therefore depends on decision maker ability to identify and understand the nature of uncertainty surrounding the key variables, and on the other, having the tools and methodology to process its risk implication. Now, the term risk and uncertainty are often used interchangeably, but a distinction should be made between them. I have already shown you the distinction. So you are required to write the same thing in the examination. With risk, there are several possible outcomes, which upon the basis of past relevant experience can be quantified. So past experience we may refer. In areas of uncertainty, again, there are several possible outcomes, but with little past experience, it will be difficult to quantify its likely effects. A risky situation is one where you can say that there is a 70% probability that returns from a project will be in excess of rupees 8 lakhs, but a 30% probability that returns will be less than rupees 8 lakhs. If, however, no information can be provided on the returns from the project, we faced with an uncertain situation. So managers need to exercise caution when assessing future cash flows to ensure that they make appropriate decisions. If project is too risky, it might need to be rejected depending upon the prevailing attitude to risk. The simplest method of accounting for risk in capital budgeting is to increase the cutoff rate. Mind this language. The simplest method of accounting for risk in capital budgeting is to increase the cut-off rate. Cut-off rate means cost of capital or the desired rate of return or the discounting factor by certain percentage on account of risk. The projects which are more risky and which have greater variability in expected return should be discounted at higher rate as compared to the project which are less risky and are expected to have lesser variability in returns. The greater drawback of this method is that it is not possible to determine the risk premium rate appropriately. And moreover, it is the future cash flow which is uncertain and requires the adjustment and not the discount rate. In general, risky projects are those whose future cash flows and hence the project returns are likely to be variable. The greater the variability is, the greater the risk. The problem of risk is more problem of risk is more acute with capital investment decisions than other decisions because estimates of cash flows might be for several years ahead, such as for major construction projects. Actual cost and revenues may very well above or below budget as the work progresses. Now, risks associated with projects are stand-alone risk. Mind these terminologies because you have to use these terminologies if a question case study which comes in your examination that what we are doing right now. Stand-alone risk. It is a risk associated with single project alone. Corporate risk. It is a risk of choosing a project which affects the overall company profits or positions. Next comes market risk. It is a risk of choosing a project which affects the shareholders' position in company. Then liquidity risk, to face difficulty in converting an investment into cash. It means investors are not able to get fair value on selling its investment when they need cash immediately. Then comes inflation risk. It is a loss of purchasing power. It means the quantity of goods you bought in rupees 5 now you can buy in rupees 8. Due to the time variation, the value of money decrease. This is known as inflation. Now, as it is given in the question, that is, just have a look. It is given, it is expected that 20,000 units will be sold each year at a selling price of rupees 3 per unit. Variable production costs are expected to be 1.65 per unit, while incremental fixed cost, mainly the wages of a maintenance engineer, are expected to be rupees 10,000 per year. Discounting rate considered by the company is 12% for investment appraisal purposes. And the expectation is that investment projects to recover their initial investment within 2 years. So freezing this, we are going to analyze. Assuming the cash flows occur evenly throughout the year, then contribution per unit is 3 minus 1.65, that is 1.35. Total contribution for 20,000 units, that is 27,000 per year. Annual cash flow, that is 27,000 minus 10,000, that is 17,000. So payback is 2.9 years. Okay, so it is basically based on the various consideration that you are going to take when there are risks and uncertainty that we have discussed. So it is a case study based question. Now we are coming to sensitivity analysis. Now, first we are required to consider what is the meaning of sensitivity analysis. That is, in the context of capital budgeting process, we are going to justify what are the factors or the variables which are going to affect with a little change in the net present value. Now, sensitivity analysis assess how responsive the project's NPV is to changes in the variables used to calculate that NPV. So remember, in the context of capital budgeting, we are going to calculate profit after tax and then we are going to add back depreciation. So the sensitivity analysis assess how responsive the project's NPV is to changes in the variables used to calculate that NPV. So we are going to have number of units, we are going to have selling price per unit, we are going to have variable cost per unit, we are going to have contribution per unit, we are going to have total contribution, and from there we are going to deduct the fixed cost, we are going to have the income. That is, we are going to have, that is, deductions for depreciation, then deductions for tax, then profit after tax, add back depreciation, that will be the cash inflows. Now, one particular approach to sensitivity analysis, the certainty equivalent approach, involves conversion of the expected cash flows of the project to riskless equivalent amounts. Okay, that is the method which is actually being followed. Sensitivity analysis is one method of analyzing the risk surrounding a capital expenditure project and enables an assessment to be made of how responsive the project's NPV is to changes in the variables that are used to calculate that NPV. So, the NPV could depend on a number of uncertain independent variables. So, amongst the variables, we are having selling price, sales volume, cost of capital, initial cost, operating cost, and the benefits. The basic approach of sensitivity analysis to calculate the project's NPV under the alternative assumption to determine how sensitive it is to changing conditions. An indication is thus provided of those variables to which the NPV is more sensitive, that is critical variables, and the extent to which those variables may change before the investment results in a negative NPV. So, sensitivity analysis therefore provides an indication of why project might fail. Management should review critical variables to assess whether or not there is a strong possibility of events occurring which will lead to a negative NPV. Management should also pay particular attention to controlling those variables to which the NPV is particularly sensitive once the decision has been taken to accept the investment. A simple approach to deciding which variables the NPV is particularly sensitive to is to calculate the sensitivity of each variable. Sensitivity is equal to NPV divided by present value of projects variable expressed in percentage. The lower the percentage, the more sensitive is NPV to that project variable, as the variable would need to change by a smaller amount to make the project non-viable. Okay, now we are going to consider this problem. XYZ is considering a project for which the following estimates are available. Initial cost of the project is given 10 lakhs. Selling price per unit is 60. Cost per unit is 40. Sales volume, year 1, 20,000 units. Year 2, 30,000 units. Year 3, 30,000 units. Discount rate is 10% per annum. You are required to measure the sensitivity of the project in relation to each of the following parameters. Number A, sales price per unit, then unit cost, then sales volume, then initial outlay, and number last, project lifetime. And here we are required to ignore the tax. Now, NPV we are going to calculate as usual, 20,000 units multiplied by sales price minus variable cost, that is contribution, that is 20,000 into 20 divided by 1.1 plus 30,000 into 20 by 1.21, 30,000 into 20 by 1.331. So we are going to have 10%, that is 1.1 whole to the power 1, then 1.21, then 1.331. So we get NPV is equal to rupees 13,10293 minus 10 lakhs, it comes to rupees 3,10,293. Now, measurement of sensitivity is as follows. When you are going to consider sales price, that is, let the sale price per unit be S, so that project would break even with zero NPV, that is 10 lakhs is equal to 20,000 into S minus 40, 30,000 into S minus 40 plus 30,000 into S minus 40 divided by 1.1, 1.21 and 1.331. So solving we get S is equal to rupees that which represents the fall of, that is 0.079 or 7.9%. Now, if sale price decrease by say 10%, then NPV will be, that is, we get, just have a look, calculation, minus 10,000 plus 20,000 into 14 to the power 1.1, 1.1 square, 1.1 cube. So that NPV decrease, we get 126.68%. If unit cost increase by 10%, the new NPV will be, that is NPV, we calculate, that is NPV we get decrease, that is 84.46%. If sales volume decrease by 10%, then NPV will be, that is 179,263. That is NPV decrease percentage is 42.22%. If initial outlay increased by say 10%, the NPV will be as follows. That is NPV decrease 32.22. Same calculations with different figures we are doing. Then present value for first 2 years. Okay. Present value for first 2 years, we get 140,800 negative. The project needs to run for some part of the third year, so that present value returns is this and that. Then what we are going to see when we are going to calculate the sensitivity, just have a look. Selling price, the sensitivity is 7.9%. That is, if question arises, you are required to measure the sensitivity of the project in relation to each of the following: selling price per unit. So, selling price, where let the sale price per unit be S, so that project will break even with zero NPV. Sensitivity we have calculated 7.9%. If sale price decrease by say 10%, so NPV decrease will be 84.46%. If volume decrease by 10%, NPV decrease is 42.22%. If initial outlay increase by 10%, NPV decrease is 32.22%. So what do we get? We get that the most sensitive, that is what I have said, that is 7.9%. Okay, that is change in the selling price, then there will be a fall of 7.9%. So this is more said to be the most sensitive part. If due to the 7.9%, okay, the NPV will be decreased. So that is the most sensitive part. So I think you have understood what I want to mean. Okay. Now just have a look. Let me discuss that last problem also once more. If we are going to judge the sensitivity, and I have told you that the lowest percentage, which is actually giving a huge change in the NPV, is said to be the most important factor or the critical factor, and that is more sensitive. Let us come to this once more, please. Sensitivity is equal to NPV divided by present value of project variable, that is calculated in terms of percentage. The lower the percentage, the more sensitive is NPV to that project variable, as the variable would need to change by a smaller amount to make the project non-viable. Okay, so we have discussed this. Calculation is simple. You are going to calculate the NPVs and you are going to take into consideration the various ways and outs so far the NPV calculations are concerned. And if a little percentage change is going to affect the NPV more, that is going to be the most critical factor or the most sensitive factor. Now we are coming to our next question. You have been appointed as a financial consultant of ABC Limited and to advise the company whether ABC company should replace its fleet after 1 year, 2 years or 3 years. Okay, the facts of the case are given as under. This is also a case study based problem. So what we are going to do, it is given you have been appointed as a financial consultant of ABC Company Limited and to advise the company whether ABC company should replace its fleet after 1 year, 2 years or 3 years. The facts of the case are given as under. ABC company services custom cars and provides its clients with a free service car while servicing is taking place. It has a fleet of 10 free service cars which it plans to replace in the near future. Each new free service car will cost rupees 15 lakhs. The trade-in value of each new car declines over time as follows. Age of free service cars in years and trade-in value, that is rupees car. So gradually it is declining. Servicing and parts will cost rupees 1 lakh per free service car in the first year, and this cost is expected to increase by 40% per year as each variable grows older. Cleaning the interior and exterior of each free service car to keep it up to the standard required by ABC company's clients will cost rupees 50,000 per car in the first year, and this cost is expected to increase by 25% per year. ABC company has a cost of capital of 10% and taxation to be ignored. So our problem is concentrated on, that is, we are required to advise to the company whether ABC company should replace its fleet after 1 year, 2 years or 3 years. Okay, and we are given relevant information. So we are going to consider, just have a good look. First, we are going to consider replace every year. So here we are going to consider 0 and 1. Initial cost is 15 lakhs. Trade-in value 11 lakh 25,000. Service cost is a deduction, that is 1 lakh. Cleaning cost 5 lakhs. Net cost outflow 15 lakhs and 9 lakh 75,000. Discount factor at the rate 10%. That is 1 at 0th year. At the end of year 1, it is 0.909. So present value comes to 15 lakhs and 8 lakh 86,275. So net present value comes to 613,725. Annuity factor 0.909 at the rate 10%. So equivalent annual cost comes to 6,75,165. So that is 1 year, that is replace every year. Now, when you are going to have that is replace every 2 years, then we are going to have year 0, 1 and 2. Initial cost we have taken 15 lakhs, trade-in value at the end of year 2, that is 9 lakhs, service cost first year 1 lakh, second year 1 lakh 40,000, cleaning cost first year 50,000, second year 62,500, net cost we are having 15 lakhs, 1 lakh 50 and 6 lakhs 97,500. Then discounting factor we are considering 0.909 and 0.826. So present value we get, then net present value we get, annuity factor, that is summation of the discounting factors, is 1.735. So equivalent annual cost, it comes to 6,11,075. Now we are coming to replace every 3 years concept. That is same, we are going to have 0, 1, 2, 3. Trade-in value we are going to get in the third year. Service cost we have taken. Cleaning cost we have taken. Net cost we have taken. Discounting factor we have taken. Present value we have taken. Net present value we have taken. Annuity factor for the 3 years at the rate 10%, it comes to 2.486. Then equivalent annual cost, we get 651,232. Then remark and conclusion, what will be there? That is equivalent annual cost. You see, when replacement is every 3 years, equivalent annual cost is 651,232. And when it is replacement, that is every 2 years, it is 611,075. And replacement every year, it is 675,165. So equivalent annual cost is minimum when it is replaced at the end of every 2 years. At the end of every 2 years, that's remark we are writing. Equivalent annual cost for replace every 2 years is the minimum. Hence, ABC company should replace its fleet after 2 years. Now, before coming to the next question, just I'm looking if you have any question up to this, because we are required to consider entire thing within limited time. So if you have any question, please write in the chat box and I am going to answer that. You have not asked any question right now. Now we are coming to the next problem. As a finance manager of company H Limited, the following information in respect of a project GIL is available. Cash flows here rupees. Capital cost of the project 1,10,000. Director finance of the company is asking the finance manager to calculate IRR for the project so that he can have an estimate of cut-off rate, that is the discounting rate or the minimum desired return. Do you agree with the view of Director Finance? If so, calculate IRR and report the same to Director Finance. Okay. Now we are going to write the reports to Director Finance from Finance Manager. Internal rate of return will be calculated by the trial and error method. Here the cash flow is not uniform. Thus, to have an appropriate idea about such rate, we can calculate the guidance rate to start with. It represents the same relationship of investment and cash inflows as in case of payback period calculation. Therefore, it is known as fake payback period. F stands for fake payback period, that is I divided by C, where I is equal to original investment, C is equal to average cash inflow per annum. Factor of the project, that is 1,10,000 divided by 35,000, that is 3.14, also known as fair payback period. The factor will be located from the table. Present value of an annuity of rupee 1, representing the number of years corresponding to estimated useful life of the asset. The approximate value of 3.14 is located against 10% in 4 years in the present value of an present value factor table. Now we are going to calculate the net present value taking into consideration two discounting rates, that is 10%, and looking into the NPV that will be calculated. Then we are going to look into a higher discount rate. You see, NPV is positive at a discounting factor of 10%. So by trial and error, we actually go for higher rate of discounting rate, that is 12%, where we see NPV is negative. So definitely IRR lies between one positive and negative value, and applying 10% discount as the discount rate, it has been found that NPV is rupees 2720 positive. So you have to make NPV is equal to 0, because IRR lies between one positive value and one negative value. To make it 0, the present value of cash inflows is to be reduced. Therefore, at higher discount rate, 12% has been used in the next step, and the NPV has been negative, that is 1560. So NPV is positive at 10% and negative at 12%. It indicates that NPV is 0 at a discount rate which is more than 10% but less than 12%. So IRR lies between one positive value and another negative value. And the formula that I have already shown to you today, so far IRR is concerned, by applying that formula, we get IRR is 11.28%. Since the desired rate of return or the cutout rate or the discounting rate, okay, that is director of finance of the company is asking the finance manager to calculate IRR for the project so that he can have an estimate of cutoff rate. Do you agree with the view of director of finance? If so, calculate IRR and report the same to director of finance. So we have done all the necessary calculations, and it is seen that using simple interpolation, IRR is 11.28%. Since IRR of the project is higher than the cost of capital, the project is acceptable. So that is a practical example of considering a project with the help of calculating the IRR. Now we are coming to the certainty equivalent approach. Another method is the certainty equivalent approach. By this method, the expected cash flows of the project are converted to riskless equivalent amounts. Mind the language. Another method is the certainty equivalent approach. By this method, the expected cash flows of the project are converted to riskless equivalent amounts. The greater the risk of an expected cash flow, the smaller the certainty equivalent value for receipts, or the larger the certainty equivalent value for payments. As the cash flows are reduced to supposedly certain amounts, they should be discounted at a risk-free rate. Now we are coming to solve one problem. The Textile Manufacturing Company Limited is considering one of two mutually exclusive proposals, Project M and N, which require cash outlays of rupees 8,50,000 and rupees 8,25,000 respectively. The certainty equivalent C in short approach is used in incorporating risk in capital budgeting decisions. The current yield on government bonds is 6%, and this is used as the risk-free rate. The expected net cash flows and their certainty equivalents are as follows. Project M, Project N. So year-end cash flows are given, and CE certainty equivalent factor is given for both the projects. Present value factors of rupee 1 discounted at 6% at the end of year 1 to 3 are 0.943, 0.890 and 0.840 respectively. Now the question is, which product should be accepted? If risk-adjusted discount rate method is used, which project would be appraised with a higher rate and why? So we are going to have, first, we are preparing a statement showing the net present value of project M. So we are taking year-end 1 to 3, then we are jotting down cash flows, then C as it is given, then adjusted cash flows, that is cash flows multiplied by C, we get the adjusted cash flows. Present value factor at 6%, that we have jotted down 0.943. So total present value we get, that is C into D, that is adjusted cash flows multiplied by present value factor at 6% at the end of year 1. We get present value at the end of year 1, 339,480. Similarly, at the end of year 2, 3,11,500. At the end of year 3, 2,10,000. So total present value comes to 8,60,980. Less initial investment. So net present value, we get positive 10,980. Now, statement showing the net present value of project N, similar fashion, similar manner, that is net present value we get. So far, total present value is concerned. So for project N is concerned, it is 9,96,315. Less initial investment, that is 171,315. That is net present value. So decision, since the net present value of project N is higher, so the project N should be accepted. Now we are going to the second part. If risk-adjusted discount rate method is used, which project would be appraised with a higher rate and why? So we are coming to the second part. Certainty equivalent coefficient of project M is lower than project N, that is 2.4. This means project M is riskier than project N. As higher the riskiness of a cash flow, the lower will be the CE factor. If risk-adjusted discount rate method is used, project M would be analyzed with a higher rate. Okay. Now we are coming to probability analysis. A probability analysis of expected cash flows can often be estimated and used both to calculate an expected NPV and to measure risk. A probability distribution of expected cash flows can often be estimated, recognizing there are several possible outcomes, not just one. This may be used to do the following. Step 1. Calculate an expected value of the NPV. Step 2. Measure risk. For example, in the following ways. By calculating the worst possible outcome and its probability. By calculating the probability that the project will fail to achieve a positive NPV And finally, by calculating the standard deviation of, of the NPV. So these we may take in the context of capital budgeting, and that is all about so far capital budgeting techniques or investment decision making techniques are concerned. Remember, I have just told you the area where you are required to study and what you are needed to do for writing your examination paper. So keep this in your mind, and we have got some time. We are going to start our next topic that I'm going to start right now. Just a minute. That is, we are going to start mutual funds. Now, this is also a very important topic in your strategic financial management paper, and you may expect one question from mutual funds. Now, first we are discussing some viewpoints so that you can easily understand what is mutual fund and how the net asset value of the mutual fund is calculated, how to consider the particular mutual fund depending upon the risk, etc., that we are going to discuss. Now, first I am going to discuss about establishment of a mutual fund. Now, a mutual fund is required to be registered with the SEBI before it can collect funds from the public. All mutual funds are governed by the same set of regulations and are subject to monitoring and inspections by the SEBI. Now, the mutual fund has to be established through the medium of a sponsor. A sponsor means any body corporate who, acting alone or in combination with another body corporate, establish a mutual fund after completing the formalities prescribed in the SEBI's mutual fund regulations. Now, the role of sponsor is akin to that of a promoter of a company who provides the initial capital and appoints the trustees. The sponsor should be a body corporate in the business of financial services for a period not less than 5 years, be financially sound, and be a fit party to act as sponsor in the eyes of SEBI. The mutual fund has to establish either a trustee company or a trust under the Indian Trust Act, and the instrument of trust shall be in the form of a deed. The deed shall be executed by the sponsor in favor of the trustees named in the instrument of trust. The trust deed shall be duly registered under the provisions of the Indian Registration Act. The trust deed shall contain clauses specified in the third schedule of the regulations. A mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. A mutual fund is the most suitable investment for the cautious investor, as it offers an opportunity to invest in a diversified, professionally managed basket of securities at a relatively low cost. So we can say that Mutual funds are trusts which pull resources from large number of investors through issue of units for investments in capital market instruments such as shares, debentures, and bonds, and money market instruments such as commercial papers, certificate of deposits, and treasury bonds. An asset management company who holds an approval from SEBI is to be appointed to manage the affairs of the mutual fund, and it should operate the schemes of such fund. The asset management company is set up as a limited liability company with a minimum net worth of rupees 10 crores. The sponsor should contribute at least 40% to the net worth of the asset management company. The trustee should hold the property of the mutual fund in trust for the benefit of the unit holders. SEBI regulations require that at least 2/3 of the directors of the trustee company or board of trustees must be independent. That is, they should not be associated with the sponsors. Also, 50% of the directors of asset management company must be independent. The appointment of the AMC can be terminated by majority of the trustee or by 75% of the unit holders of the concerned scheme. The asset management company may charge the mutual fund with investment management and advisory fees subject to prescribed ceilings. Additionally, the asset management company may get the expenses on operation of the mutual fund reimbursed from the concerned scheme. The mutual fund also appoints a custodian holding valid certificate of registration issued by SEBI to have custody of securities held by the mutual fund under different schemes. In case of dematerialized securities, this is done by depository participant. The custodian must be independent of the sponsor and the aims. Now, we are in a position to divide the mutual funds. Rather, there are various classifications of mutual funds. There are 3 different types of classification of mutual funds. That is, number 1, functional, number 2, portfolio, and number 3, ownership. So in functional classifications, we are having number 1, open-ended funds and closed-ended funds. And in an open-ended scheme, the investor can make entry and exit at any time. Also, the capital of the fund is unlimited and the redemption period is indefinite. On the contrary, in a closed-ended scheme, the investor can buy into the scheme during initial public offering or from the stock market after the units have been listed. The scheme has a limited life at the end of which the corpus is liquidated. The investor can make his exit from the scheme by selling in the stock market or at the expiry of the scheme or during repurchase period at this option. Interval schemes are a cross between an open-ended and closed-ended structure. These schemes are often for both purchase and redemption during pre-specified intervals, namely monthly, quarterly, and annually, at prevailing net asset value based prices. Interval funds are very popular to closed-ended funds but differ on the following points. They are not required to be listed on the stock exchanges as they have an inbuilt redemption window. They can make fresh issue of units during the specified interval period at the prevailing net asset value based prices. Maturity period is not defined. Now we are having portfolio classification. Funds are classified into equity funds, debt funds, and special funds. So equity funds invest primarily in stocks. Equity funds are of the following types. Number one, growth funds. They seek to provide long-term capital appreciation to the investor and are best to long-term investors. Then aggressive funds. They look for supernormal returns for which investment is made in startups, initial public offers, and speculative shares. They are best to investors willing to take risk. And thirdly, income funds. They seek to maximize present income of investors by investing in safe stocks paying high cash dividends and in high yield money market instruments. They are best to investors seeking current income. Now, apart from equity funds, we are having debt funds. Debt funds are of two types, namely number A, bond funds. They invest in fixed income securities, that is government bonds, corporate debentures, convertible debentures, and money market. Investors seeking tax-free income go in for government bonds, while those looking for, say, steady income by government bonds or high-grade corporate bonds. Next, we are having gilt funds. They are mainly invested in government securities. Apart from debt funds, we are having special funds. And special funds are of four types. Index funds. Every stock market has a stock index which measures the upward and downward sentiment of the stock market. Index funds are low-cost funds that influence the stock market. The investor will receive whatever the market delivers. Then international funds, a mutual fund located in India to raise money in India for investing globally. Then offshore funds, a mutual fund located in India to raise money globally for investing in India. Then sector funds, they invest their entire fund in a particular industry, namely utility fund for utility industry like power, gas, public works. Apart from that, there is money market funds. These are predominantly debt-oriented schemes whose main object is preservation of capital, easy liquidity, and moderate income. To achieve this objective, liquid funds invest predominantly in safer, short-term instruments like commercial paper, certificate of deposits, treasury bill, government securities, etc. Now, our next consideration is net asset value. So I'll stop. Once we go through this net asset value, then I will stop for the day and I'll be taking it back in the next class so that after completing this mutual fund, we can go to the leasing chapter. Now, what is net asset value? It is the amount which a unit holder would receive if the mutual fund were owned up. An investor in mutual fund is a part owner of all its assets and liabilities. Returns to the investor are determined by the interplay of two elements, net asset value and cost of mutual fund. Remember, two important elements. One is net asset value and the second one is cost of mutual fund. Net asset value is the mutual fund's calling card. What is this? It is the basis for assessing the return that an investor has earned. There are three aspects which need to be highlighted. Number one, it is the net value of all assets less liabilities. NAV represents the market value of total assets of the fund less total liabilities attributable to those assets. NAV changes daily. The value of assets and liabilities changes daily. NAV today will not be NAV tomorrow or day later. And number three, NAV is computed on per unit basis. That is dividing the net asset value by number of outstanding units. So we'll come to this in the next class. Okay. Hope whatever I have discussed today. Now let's see anybody has asked any question or not. Now there is no question which is actually being asked. Now just I will tell how net assets value is calculated, and then we should proceed in the next class. Net asset value calculation, how is to be made? It is value of net assets of the funds. The investor's subscription is treated as the unit capital in the balance sheet of the fund, and the investments on their behalf are treated as assets. The fund's net assets are defined as the assets less liabilities, and accordingly, NAV is equal to net assets of the scheme divided by number of units outstanding. Net assets of the scheme is equal to market value of investment plus receivables plus other accrued income plus other assets minus accrued expenses minus other payables minus other liabilities. So we are going to stop today, and we are going to continue with the mutual fund in the next class. And then after doing the mutual fund, we are going to start leasing. Okay, so thank you for your kind patience and listening to me, and see you in the next class. Till then, goodbye.
Thank you, sir.
Thank you. Thank you very much.